Today's session focuses on advancing fair competition in digital financial services, and we are very pleased to have one of our alumni here, Dr. Anthea Paelo, leading the dialogue today. Just a brief introduction to Dr. Paelo. She's an economist with over a decade of experience working in competition, economics, economic regulation, gender and financial sector development across the East and Southern Africa. Her work focuses on the intersection of competition, policy, digital financial services, and women in financial inclusion, with a really strong interest in how market structure, regulation, and platform dynamics shape outcomes for underserved populations. She is currently the policy expert and financial for competition in at the Alliance for Financial Inclusion, where she leads the competition enablers knowledge exchange, supporting policymakers to regulate and integrate competition and inclusion considerations into regulatory and supervisory frameworks. Before this, Anthea worked with financial sector deepening Uganda, obviously Uganda, which I'm sure most of us are familiar with, managing the policy and business environment portfolio and supporting gender intentional approaches to financial sector reform. Dr. Anthea is also a CDFP graduate from Digital Frontiers, and we are so pleased to have one of our alumni sharing with us today. Just in terms of the plan for the next hour, Dr. Anthea Paelo will share a poll, and we'd love to hear your responses. And then for the brief introduction, we'll get right into sort of the meat of the discussion today. Please feel free to use the chat to share any questions. We will have a short, we'll try as much to have a Q&A session, an engaging Q&A session at the end of the dialogue. But please feel free to use the chat in the interim. Thank you so much, and over to you, Anthea.
Thank you so much, Kotha. Such a pleasure to be here. And good afternoon or good morning to all of you. I'm very pleased to be able to present this work to you. I recognize a few names and appreciate your presence here. As Kotha mentioned, I'm Anthea Paelo, and I'm presenting work that was commissioned by the Alliance for Financial Inclusion, which is an association of 91 member countries, central banks in different member countries in Sub-Saharan Africa, across South and East Asia, and parts of Europe. First of all, I'd just like to be able to get to know a little bit of who is in the room and what you'd be expecting from the session. So I'm just going to ask Kotha to please help us to share the poll, and feel free to introduce yourselves as well in the chat. Great, thank you.
Oh, live? Okay, perfect.
Yeah. Maybe it'll take just 2 minutes or so to. Okay. I think a big part of this is just trying to see how to tailor it and how to make it, how to make the content as easy or easily understood for the audience. So yes, to know if competition policy is new to you, if you already work with it, or if there's already some good understanding. So from what I see here for now, for at least I think a portion of you already understand or have some understanding of competition issues. You know a little bit. That's okay. Maybe two people are completely new to the topic. We have fintechs in the room. We have a bank, a regulator, another someone from another institution, and only one person is confident that there's a competition challenge that they're experiencing. Maybe I'll get started, but feel free to keep on providing your input in the chat as well. Okay. So I want to share with you first a little bit of what Alliance for Financial Inclusion and the Competition Knowledge Exchange, that the platform where we're learning about competition, is about. And I'm going to do that through a video. I hope you'll all be able to hear it and understand it. Give me a minute. Okay. This is about the Competition Knowledge Exchange.
We've seen a significant growth in terms of adoption of digital payment systems, but we still have a challenge in terms of competition. We still have a challenge in terms of interoperability. We have a challenge in terms of pricing. We have a challenge in terms of new entrants accessing the market.
We ran a survey amongst the RP network to get their views on competition and its implication on financial inclusion.
Without competition, you can't really have sustainable financial inclusion, and much so, it's also an ingredient that also supports the other core mandates of regulators. That includes effective transmission of monetary policy, financial stability, and of course, consumer protection.
So from the conversations with the members, what we've come to understand is that the key challenge they're facing is that there are high prices for the consumers, limited competition in terms of the variety of services that are available for the consumers. They also struggle with the fact that sometimes there are very large players in the market, which in turn means that the prices that they can charge is much higher than would be expected. Innovative fintechs that come into the market, they face challenges in enabling them to access key infrastructure such as the payment systems, infrastructure such as USSD, and all of this matters because at the end of the day, it increases the price that the consumer has to pay.
So based on this guidance from the members, we started a pilot in 2024, April, on Competition Enablers Knowledge Exchange. We have about 14 countries who are part of this pilot. We have been running technical sessions, country sharing experiences, knowledge product generation.
So this particular piece of work will be helpful in informing our policy designs, using existing tools, looking at the way we can engineer positive outcomes for consumers. And these include initiatives such as enhancing interoperability, exploring open banking, and ways that we can make it easier for new entrants, fintechs, to provide competitive solutions and better outcomes for our consumers.
Okay, thank you so much. I hope you're able to hear that. So just to jump off on that, what the video was showing, the Competition Knowledge Enablers Exchange is a work stream under the Alliance for Financial Inclusion, and it was started as an initiative to try and understand how competition might affect financial inclusion and other central bank core objectives and mandates. So we started with 14 pilot countries, but it's slowly being scaled up as more and more countries are realizing that competition does have an impact on how different financial service providers interact in the market, which might affect pricing, it can affect stability, integrity. And so financial regulators globally are beginning to deal with this. And it's under this that the workstream was developed. And we're hoping to share with you a bit about what financial regulators are beginning to think about, to get your own points of view, and such that we all play our role in enabling a stable financial sector. I've shared with you the link on the AFI website where you can get a bit more information on some of the work that we've been doing over the past year. So what I'm going to do quickly is to just share the context and why this is important, why we're looking at competition, especially in the DFS markets. We look at the specific competition concerns that we've been looking at and how the regulators are beginning to respond to competition. And then I'll conclude and hope and get some inputs from you as well on what is happening in your markets, if this resonates with you or if there are certain challenges that you see. And so why did we do this special report? I'm sure most of you in the room will know that DFS has been the biggest driver for financial inclusion over the last decade or so. But as much as there's been substantial growth, there's also been concentration. And what do I mean by concentration? There have been emergence of large players across different sectors in the market, whether it's in payments, whether it's in e-commerce. And this has had implications on the nature of competition, the ability for new entrants or new financial service providers to enter into the market, and even the ability to compete effectively, whether it's by innovating or whether it's by providing much better effective prices for consumers. And we've seen instances of abuse of dominance, which can limit innovation and harm consumers. And so this report was drafted with support from Akasha Economics, based in South Africa, but in supervision and guidance of the members of Competition Knowledge Exchange. And the goal really is to enable AFI members who are central banks across globally to promote fair, competitive, and inclusive digital financial markets. So the context in which this work is done is that we're seeing that there's been advances in technology and digitalization. There are new types of institutions. It's not just the banks anymore. We're seeing digital banks, we're seeing mobile money providers. We're seeing that there's huge amounts of data that is now available to provide financial services. We're also seeing that it's no longer about the physical location of services. That is no longer dependent for provision of financial services. The rails and infrastructure is also changing rapidly, and even the cost associated with provision is changing because we're no longer using the same capital or physical locations to provide financial services. So there have been a substantial evolution, and this has varied across different countries. The extent to which consumers have had access to financial products is changing, the use cases that are available, the customers that we are able to reach, all depending on the type of infrastructure that is available in different countries. We also see that the different jurisdictions have different and varying regulatory frameworks. And then also the evolution depends as well on the consumer ease and use and familiarity of technology. So there are different factors, and evolution has not been the same across different nations. And this has an impact as well on how different providers interact in the market. So the evolution has led to changes in the business models. We have those that are telco-led in terms of SIM cards, mobile money, mobile airtime. We have agents, USSDs, different kinds of business models to provide different kinds of financial services. We also see bank-led and neo-banks that are now available in many of the jurisdictions. You can see now digital-only banks that you can only access via the internet. You don't have to move into a bank location or a branch location in order to open an account. We're also seeing platform-led financial service providers. A number of you are able to access shopping and e-commerce services through the different platforms, whether it's, for instance, Shein, or whether it's you access services through Alibaba. There are different ways in which you can access financial services. That is platform-led. That began initially from a service that was not a financial service provider, but which over time integrated and began to provide payment services. So this has changed. The different inputs have been necessary for this, whether it's switches, whether it's identity and KYC data, transaction and customer data, and also depending on the devices that are available. So what has this evolution meant for the competitive environment? We're seeing on the positive side, there are more competitive prices. I'm sure there are lots of choices. I was, for instance, able to easily send money last week to Mozambique using an app, Mukuru. There are different ways, much cheaper, much faster, different ways in which you can access financial services. There's improved quality and customer care. You don't have to stand in a queue in order to access an agent, for instance. There's gains for merchants. Merchants are they are able to process their payments much faster. Even the small enterprises, even the small shops are able to access these financial services. So there's deeper financial inclusion that is being experienced. But there are instances in which competition fails to deliver these needs. And this is, competition can be imperfect where there are instances of market power. Market power refers to the ability to charge prices above a competitive level. If, for instance, you have, for instance, you're one of the largest players in the market and there is limited choice, you, as a financial service provider, might be able to charge higher prices because the consumer has little choice. So firms may have the ability to raise prices above a competitive level. They may also not have as much incentive to provide quality products because, again, there's little competition. And so where there's often results where there's market failure and barriers to entry and expansion, that's where you find that the competition fails. And we have three key categories of barriers that can lead to that can create a situation where competition fails to work. There can be instances of structural barriers. How the market is shaped can affect effective competition. It can be strategic barriers, where a financial service provider engages in conduct that deliberately causes unfair competition, or they could be regulatory barriers that affect competition. So I'll just give some brief examples across these three. In terms of structure, we have economies of scale. The way the DFS market is shaped, you have to have economies of scale in order to perform effectively. And so what that means is that if you are first incumbent in the market, you're often able to attract a large mass of consumers. And because you have benefiting out from that, or as a consumer, you're benefiting from having a large network of operators, you're not going to move to a new player. I often ask in any of this, I don't know how many people have changed whether it's their bank account or whether it's even their cell phone number in the last, say, 2-3 years. Often it's just too difficult. People already have your number. It's just a lot more difficult. It causes high switching costs. Then there's also information asymmetry. You might be able to you may not know what value you might be able to get from another player or from another provider in the market. And here I break down a little bit in terms of network effects. If you're the first to launch, you can, due to network effects, you can become very large, and then implement or prevent other players from being able to link. There might be a lack of interoperability across different players that affects the ability of new players to to perform effectively. We have seen instances in card markets. For instance, Visa and MasterCard are widely accepted. It's very difficult for a new player in the card market to come in again and compete effectively against them. They're also switching costs. It's just that much difficult to move from one provider to another. In terms of regulatory barriers, we have licensing barriers, where new players, often non-banks, might find it difficult to enter into the market. Some of it is quite reasonable. You may not be well equipped. You might cause instability, but there are also instances where the regulation is extremely tight and difficult for you to operate into the market, even if you are a sound provider. We also seen barriers to accessing infrastructure and facilities. There may be just stringent regulation, making it difficult for you to actively access the infrastructure you need to provide a service. Then disproportionate compliance burdens. We've seen instances where you're a new provider, maybe providing a singular streamlined service, but the compliance that you have to, or the regulation you have to comply with is over and above and can be burdensome, such that you're unable to provide the service that you would want to. So I've talked about the licensing requirements. I've talked about KYC requirements that can also cause certain challenges. Some of the particular regulatory barriers, we've seen instances where regulation only allows banks to operate e-money platforms, for instance, or where regulation insists that EMIs and that non-banks need to partner with EMIs or with banks or with licensed banks in order to provide a service, which can be a barrier in certain instances. The other category we have is strategic or behavioral. This is where a large player with market power engages in conduct that either prevents other players from effectively providing their services. That could be either in collusion, that could be in terms of exclusion. I have examples here that we can share. In terms of predatory pricing, we might find the instances, for instance, where a dominant player or a very large player in the market sets prices very low, specifically such that it can force other players out of the market. Prices are so low that it's unprofitable for a player to enter into the market. And once they're out of the market, you find that they're raising prices again. We've seen instances of margin squeeze where provider requires access to a key input, whether it's a switch, whether it's access to USSD, whether it's access even to agent infrastructure. And they are charged so highly for that access such that it doesn't make sense, it doesn't make profits for them. It squeezes their margins. There are also instances of tying and bundling where certain service is tied to another. We've seen a lot of Google cases. I'm sure you've seen Google Pay, even in Apple, where and even with Android, I think, where you're not able to access a service or unless you purchase one other service. If you want to access the Android platform, for instance, you'd have to access one particular payment service in order to provide that, in order to access customers. There are also instances of refusal to supply where providers completely say, no, I'm not going to give you access to USSD, no access to my APIs, and no access to my agents, for instance. There are also instances of exploitative pricing where there's just excessive, you're the only player in the market and you're charging extremely high prices. The collusion could also happen where there are agreements between competitors to charge higher margins. This often happens where there's a small number of players in the market and they have an understanding, whether it's explicit or tacit, without any obvious agreements. So just some of the examples that we've seen. We've seen certain exploitative pricing instances in terms of pricing of interchange and merchant discounts. Where the banks that are involved in these practices may choose to charge high interchange rates, and of course the goal is here is you're trying to exclude other players from the markets. Interchange fees have been a significant challenge across different jurisdictions. Another key one has been USSD access and pricing of USSD, which has been excessive in many cases. There's a particular challenge in Kenya where the Competition Authority was able to negotiate with Safaricom and Pesa to reduce the charges of access of USSD from between 2 to 10 Kenya shillings to 1 Kenya shilling. And you can imagine if you're a provider having to pay 10 Kenya shillings versus one that is charging 1 Kenya shilling for a USSD session, that has an impact on your profits overall. There have been instances of exclusionary conduct. Google Pay and the Competition Commission of India. There's been Apple Pay. Maybe just to touch on this, I'm cautious of time, but let me at least give you a little bit into some of the examples that we have here. But the full report has all of these examples if you want to go through them. Google Pay offers incentives to offered incentives to a lot of its providers, and because it also had integration with a lot of Android phones, the majority of the traffic, over 80% of the traffic on UPI, was actually Google Pay. And so the Competition Commission in India found that there might be some exclusionary conduct that's happening in how it was forcing different players to use their particular payment platform. exclusive dealing. We've talked about agent networks where at least Airtel in Kenya, and this was a while ago, before 2014, I think, Airtel Kenya reported to the Competition Authority about agent exclusivity that was dealt with by the Competition Authority and then subsequently by the regulations. And there have been different instances in South Africa as well in terms of exclusion with the switches where only a particular members of the Payment Association of South Africa were the only ones who had access. But following an inquiry, this had been changed. The inquiry was as early as 2006. So there have been different cases. Even in the price discrimination, the off-net, on-net pricing can also be considered in many cases as price discrimination, where you find that off-net rates, and this is transfers from one network to another network as much as 3 or 4 times higher than what costs being experienced on network. We've also seen in terms of platform power. And what we're starting to realize with this is that different players enter into one segment of the market. For instance, you come into the player as a telecom provider. I'm going to now leave Safaricom and maybe go to Vodacom or MTN. You come in as your primary service is to provide voice and SMS. But due to capabilities and due to improvements in technology, you're able to move beyond voice and SMS. You're now able to move into data. You're now able to move into mobile money. From mobile money, you can now go into e-commerce. And through those, you're able to carry your dominance or your strength from one segment of the market into several subsequent segments. So that matters because then you're able, you have the ability, you may not use it, but you may have the ability to engage in anti-competitive conduct across different segments of the DFS market. And of course, with data, that is further reinforced because if you have data in one area, if you're going to provide credit, data is a strength. And so you maintain that strength across different segments of the market. So we find that you're able to leverage your dominance into adjacent markets, and that creates a challenge or a concern worth monitoring. This is particularly relevant in areas where there are vertical integrations, as I mentioned, but also we'll see we see that in e-commerce in terms of payments. You first start as an e-commerce website, you introduce a social media platform, you introduce an e-payments platform, and then you might engage in conduct such as refusing other people to access your payments platform or limiting your users to only your payment platform. We've seen that in leveraging dominance in devices, say payments by Apple, and we've also seen that with Google payment processing, Google in India. And so this might appear quite small on your screens, but just showing the different ways in which there are opportunities to engage in anti-competitive conduct. It can begin right at the start in terms of connectivity to access of services, whether it's just at the very start in terms of the mobile network, whether an entrant has the ability to even access their customer through a mobile network can creates a bottleneck or an opportunity for anti-competitive conduct. This could also happen now at the distribution level in terms of agents, or whether it's apps or ATM networks, where certain providers might exclude newer providers from the market. It can also continue on to onboarding because we find there's also a smaller number of firms that actually have the ability to verify information, the identity, and that creates an opportunity, and then even across different products and services. It's for this reason that we're particularly concerned about platforms and digital financial services, because we understand that digital financial services has the opportunity to grow financial inclusion, especially for excluded segments, including women, including the youth, including rural populations. But if there are instances where there are players that are enjoying supernormal profits and are able to exert anti-competitive behavior or engage in this in different areas, that can halt the process that we're hoping to see, or the progress that we're hoping to see in terms of financial inclusion. This is not to say that all players engage in this conduct. In fact, we are seeing certain large players are able to innovate, are able to produce quality of services. It is now that the regulators are beginning to say there is this opportunity, but we need to watch out for the risks, because the risks have the ability to affect our own goals as central banks. So that is the view in which this is being seen. So how have regulators responded to this? Regulators are responding to this by engaging in, and I'm sure you have also seen this, interventions to promote entry. We're seeing a lot of regulatory sandboxes, not just in the payment sector. We're seeing them in insurance, we're seeing them in capital markets, where it gives an opportunity for innovators to enter into the market, test their product, and for the regulator to be able to monitor. So they do it in an environment in which they're able to test and see what risks exist. We're also seeing interventions to prevent abuse of dominance, and this is from competition law. We're seeing codes of conduct. We're seeing conversations happening with dominant players and monitoring of dominant players, and there's also conduct supervision. Other interventions to ensure openness, interoperability. We're seeing in a lot of markets, interoperability is enforced or required, the terms of which are a bit different in terms of whether the cost of access is a bit different, and that also matters to financial inclusion. But interoperability in most jurisdictions is a requirement now. We're seeing data portability that is being discussed. Agent sharing is still being discussed. We've seen that agent exclusivity has largely been banned, but there's certain fintechs and other smaller providers who report that they still face certain, it's not obvious, but there are instances when they still cannot have access to agents. An agent, for instance, may not be loading float on a particular provider, even if they are not excluded. And there are certain instances like that, which of course are a detriment. So there are also interventions to protect consumers in terms of transparency and excessive pricing and interest. We have seen caps on some of the rates that are being charged, and then interventions to monitor and assess competition, whether it's developing indicators, dashboards, and regular market studies. So some of these I've mentioned, but we're seeing tiered and flexible licensing in different markets. For instance, where they're reducing even the burden for certain fintechs who enter into the market. We're also seeing where there are particular specific categories of licenses for e-money issuers, for digital banks, for agent banks. And this is just meant to encourage the smaller players to enter into the market and be able to operate. The regulatory sandbox I've talked about, where we can increase innovation, increase the pipeline of entry, and also understand what are the challenges that are being experienced. We're seeing also lower or tiered KYC requirements for smaller transactions. More open finance initiatives that are taking place across the continent. We're seeing standardized and open data exchange. We're seeing talk about infrastructure and the relationships between open banking and open finance, and seeing how we can enable switching from one player to another, one provider to another. And then this, of course, there have been discussions around whether it should be mandatory or voluntary. Right now, I think there's been a slow pace about mandatory. The preference has been for voluntary, but where this is slow to allow for interoperability or allow for gains, we're seeing increasing discussions around whether it should be mandatory. We're seeing discussions around data protection regimes, the technical infrastructure, consumer protection requirements are also becoming a key topic that are being discussed. Digital public infrastructure, another big one. We're seeing successes such as Brazil's PIX and India's UPI, but trying to see how does that work in the different markets. We've seen in Tanzania, the TIPS has been introduced. In Pakistan, RAS has been introduced. So how do we leverage digital public infrastructure to reduce the costs and enable smaller players to enter and provide, ideally, a more affordable digital financial services? I've talked about interoperability mandates and ways in which we can reduce network effects, wallet-to-wallet transfers, and even reductions in the off-net and on-net rates. Should off-net rates be much higher, much higher than on-net rates? That's the discussion that is being had. Then, of course, interventions to prevent abuse in terms of mandating access to required inputs. We're still seeing certain jurisdictions where there are complete refusals to provide access to certain infrastructure. So regulators are beginning to think, should we mandate this? There are interchange and pricing regulations that are coming into place across different areas. The new regulation that discusses this is coming into place. There's scrutiny around mergers and acquisitions. We are beginning to see certain even previously, where certain mergers were allowed to go through, where, for instance, a dominant player merged with another strong player may result in reduction of competition into the market, and which may also affect the level of competition, whether it's in terms of pricing or innovation in the market. Then, of course, vertical integration or vertical separation of platforms. In Uganda, you'd have seen that where the MTN, the telco provider, the one that provides voice and SMS, is separated from the mobile money provider. In Tanzania, that has also been the case. In Kenya, not yet, although there have been discussions that around that same topic. So these are some of the things that the central banks are now trying to see how to go forward with. We're thinking about market studies, trying to understand the market. Who are the key players? What are the terms of entry? What are the challenges? What are the indicators we should see that this market is concentrated, entry and exit? How easy is it to enter the market? How easy is it to exit the market? They want to be able to look at prices over time to say, if we're looking at these prices, and there is competition, why isn't it reducing if the costs are not reducing? Are there instances, could there be instances of collusion that may be happening if we see similar prices over time? We're seeing is customers more better able to switch from one provider to another. So they're beginning to look at how we can identify market misconduct and also how we can ensure that consumer protection concerns are covered. So in short, what regulators are beginning to understand and what we want to share with you is that competition is a key driver for innovation. That's what studies have been showing. It also can drive inclusion. We've clearly seen that in the fact that when some of these DFS providers entered into the market, financial inclusion exploded globally. But the structure of the DFS market, the fact that the network effects, the economies of scale, economies of scope, high infrastructure costs, the fact that regulatory barriers can be high, lends to a situation where there are large players and smaller players, and these players have market power or the ability to set prices, set high prices, or set prices above competitive level, which may affect the positive benefits that we're trying to see. So regulators are beginning to consider how to monitor digital markets to ensure fair entry and act early in case certain risks arise. They understand that a balanced approach is required ex ante before certain anti-competitive conduct occurs, that there's certain measures that can be put in place, whether it's enabling interoperability, whether it's open access, and then that accompanied with strong ex post enforcement, that is enforcement after an act has been engaged in, whether it's by the competition authority, which is the more appropriate regulator, can work to improve or create a more effective and competitive financial sector. And then, of course, trying to collaborate with other regulators, because what we've seen is that while financial regulators understand their markets very well, they may not understand competition so much. So they can turn to the competition regulator. There may be other regulators that are in place, whether it's the communications regulator or different ministries of finance that are similarly important, or for them to work with and to engage with, such that we have a more competitive sector. So this is what the regulators are talking about, which we wanted to share with you a bit. What I'll also, this is giving you a chance to share, but also if you want to read a bit more about the research and go into some of the examples, I'm sharing the link to the study that you can feel free to look at. I'll stop here and maybe just hand over to Kotha to lead us through the next session. Thank you.
Thank you. Thank you so much, Anthea. We have a couple of questions in the chat. Mainly, sorry, I might want to hand over to Exode, and then, yeah, Daniel has asked if we could share the presentation. Is that something we can do later on, Anthea? Perfect.
Yes,
Mr. Namawan would you like to maybe unmute and just share? I know you have two really good questions, and I'm really happy for you to ask that if you're comfortable.
Okay, thank you. Morning. Thank you, Dr. Paola, for these great insights. I'm very happy to be here and to learn all these things. So I'm working in GMAC. GMAC is the switch of all the Central African countries. So we have developed a QR code for all the six countries so that the merchant, they don't need to have many QR codes. Just one QR code can accept all the mobile application for banks and MNOs. But today we are just in Gabon. They have opened the two mobile money operator. They have opened the QR codes. But in all the other countries, for example, in Cameroon, the two MNOs don't like to open the interoperability QR codes. So we are just working to solve the issue in the policy level by working in a new policy that will make them for them to mandate them, for them to be mandatory. I don't know if it is the good solutions, because talking with them, all these things, we think that they are good to work in closed loop. They are not ready to open interoperability for the QR code. This is the issue that we are facing.
No, thank you for that. What you're speaking about is very much resonates, because you're not the only provider that is having that same challenge, where there's resistance from some of the players to connect to one switch, and they'll give there are certain economic reasons for that they'll provide. For instance, they'll say may not be able to handle the traffic. They want to ensure that. They want to ensure that it's the smooth flow, because if there's a break, the consumer is not going to blame the switch. They'll blame the network operator. So you're facing a case that is not new. I think the different providers in different markets are facing the same thing. In fact, what has been happening, I think, in Tanzania last year, towards the end of the year last year, released directives. The Bank of Tanzania released directives in which it was specifying that TIPS, which is the switch, the national switch, is now the main should be the main payment switch. But it takes time. It takes a bit of negotiation to go through that whole process, and you're very much in the right discussions in terms of whether it should be mandated or whether it should be voluntary. I think the approach that has been taken has been to have it a discussion. At least initially, to give time for the operators to get into the system, and then eventually mandate it to make it completely mandatory. I'm happy to also take this offline to discuss, because I know it can be a bit sensitive in terms of which operator does what, but that is what the regulators are doing. They first start with those voluntary initial discussions, giving a bit of time for the providers to realize that this is what is happening, and then mandate it, yes, at the policy level, have it mandated.
Yeah, very good. Just my last question is just about, as a switch, we are working to connect all the banks. We are succeeding doing it in cards, so in mobile it's ongoing. But the problem also with the mobile operators, when we are connecting, they are doing also the same work in parallel. They are connecting MFI, they are connecting banks. So and then when they connected, and it came to pass that the pricing of the switch became in competition with the pricing in the private sector. So this is also the issue that we are. So my question is, without policy, how the MNOs are they willing to play also the game of interoperability? Because I think that they are more focused on business, but us, we are focused on financial inclusion. So how to conciliate all the point of view that sometimes is not easy.
No, you're right. There's little incentive for them to link, because what they want to do, what providers want to do, is to protect their markets. It makes sense. They want to make profits, so they will want to protect their markets, and that actually is exclusion by maintaining they're separate agreements. What we've seen, or what economic theory tells us, is that initially this is absolutely okay for them in the beginning because they'll need to recoup the investments they've made in putting the infrastructure, in ensuring that those bilateral agreements go on in place. So this is fine. But at a certain point, once that investment has been recouped, it gives them, it is of bigger benefit to open up the network much wider beyond. They don't really to open up much wider to other networks. So any refusal to interoperate or to integrate with other players after the point of recoupment could be considered exclusionary. Of course, they might give instances. They might say that they need to invest in their infrastructure. But as you mentioned, the government has now put in an infrastructure that should ideally be much better, or that should take care of the bandwidth of the challenges that they're experiencing. The onus is now on the regulator or the owner of the switch to ensure that what they're providing is of good quality and actually in order to attract the players that are in the market, not just the smaller players, but even the large players.
Thank you, Anthea. Are there any other questions? Please feel free um, to raise your hand. Um, Maybe just a question from my side, Anthea. What kind of support, if there are regulators interested in strengthening competition, how can they engage with or get support from AFI on this work outside of the report?
Okay. So the competition knowledge exchange, the work stream, is beyond this report. This report was just an initial, as a start to kind of understand what's happening in the space, what are the key challenges, where the key bottlenecks are. But further on, the competition knowledge exchange wants to engage with the very topics that I think Exode spoke about. In terms of, okay, we want to attract more people into the switch to use the QR code, this universal QR code. What are the policy reviews that need to be made? So AFI would want to provide support with that in terms of support with the policy, the changes in policy, what might be, and weighing the different needs, whether it is financial stability, whether it's competition, and whether it is also the integrity of the financial service provider itself. So it's very much involved in those discussions around policy, whether it's also pricing, what would be the best way to engage into pricing. So whether it's in terms of research and the best ways in which to intervene, we're doing a lot of work on open finance, for instance. We're doing work on interchange fees and pricing. So we're doing a lot of work to support the regulators, to educate them, and also in terms of the policy review. Because AFI is an association of regulators, we provide majority of the support to the regulators, but of course open to hear what the financial service providers on the ground are experiencing, such that we can actually develop appropriate regulation.
Thank you, Anthea. Just in terms of, I think, in terms of time, I wonder if anyone else has a question. Please feel free to share it. But I guess from my side, I think, what has really stood out for me here is that competition remains a key driver of innovation. However, a barrier does seem to be that regulators often can work in silos. Um, where have you seen regulators, working together and really responding to the issues that they've had? Have you seen this in any particular country or any particular ecosystem where you've seen really positive results from regulators becoming, acting early and responding early and introducing measures such as, sandboxes, collaborating more. Are there any examples any particular standout examples for you that you could share with us? Or does it continue to be sort of a learning curve for regulators?
Thanks for that. No, it's definitely still a learning curve. There are certain jurisdictions that have tried and who have made much more progress. The UK with its Financial Conduct Authority is kind of it handles quite a bit more in terms of competition issues, market conduct issues. But a lot of the jurisdictions are beginning to see that there's need, for instance, one MOU. We know different countries. I think Kenya, there's an MOU. South Africa, there are discussions around that, on how to collaborate a bit more. In a lot of countries, they've at least reached that first step of we need to have a discussion and then MOUs. I think where more progress needs to be made is in terms of what does that mean in day to day. We have an MOU. What does that mean literally if we wanted to if we wanted to see if we wanted to see a change, if we are seeing misconduct happening, who starts, who initiates, how do we provide support to each other? Another example, and recently also Kenya had an OECD peer review of its of competition in Kenya, and they did mention in the report how they do have an MOU and they have collaborated. I think there was a digital credit sector study that they did that tried to tie in some of these issues. It was done between the Central Bank of Kenya and also the Competition Authority to try and see how to make the sector more competitive. So there's still efforts, but I think also because competition is still new, even for the financial sector, we're still trying to see additional progress there. And that is why also this work stream has been set up to kind of provide support in that area.
Yeah, thank you. Thank you, Anthea, so much for leading us through this discussion. I don't see any other questions. I think Zodis has one. Anthea says, oh, okay, he's just responding to everyone else in the chat. And in mentioning that a big loop, so if Africa can explore the Central Africa reality more deeper, a big loop on what has been done as regional switch at GIMAC, a lot has been done and not still to do. Yeah.
Yeah, I think I'll also look a bit more into that I'm going to look a bit more. I am just typing my email address
Thank you.
into the chat in case there are additional questions there. Okay. But yes, I'll definitely look at, and thank you so much for raising it. Especially cross-country, cross-regional issues can be of particular relevance. So that's a good mention. Yeah.
Okay. Are there any closing remarks from your side, Anthea?
And I just want to thank everyone for making the time, allowing me to share this. I do hope that you can go through the report and even the presentation afterwards. The goal is really to have a rich discussion around this and not to have a separate discussion, whether it's just regulators or just the financial sector. At the end of the day, what we want is an inclusive financial sector.
Yeah.
Yeah. Thank you.
Okay. Thank you. Thank you so much, Anthea, for sharing these insights and for walking us through, some of the report findings and just, shedding light on this topic that AFI has really put so much effort into understanding. I think the ongoing, this discussion really highlights the ongoing evolution of digital financial services, and how it's evolving so rapidly, which calls for more for more working together from regulators to other industry and ecosystem players. So I think thank you so much for that, for your contributions today. Just as a reminder, if anyone would like to lead a future digital finance dialogue, we would be delighted to hear from you. I will share my email in our thank you, just a follow-up email after this call. If there are no other closing remarks, I think we can close with that.